Welcome to this walkthrough of our cap table model. In this video, we'll walk you through how to model the conversion of a convertible note and how it impacts ownership before and after a priced round. This accompanies our blog post, so be sure to download the model and have a read on the article to better follow along. In our example, we have a company that starts out with 10 million shares outstanding. 9 million shares belong to the founders and 1 million to the employees. The company had raised $100,000 from an angel investor last year through convertible notes. The notes carried a valuation cap of $4 million, a discount of 20%, and an interest rate of 10%. This year, the company is raising a seed round and has received a term sheet for a $2 million investment at a $6 million pre-money valuation. The investor wants a 25% stake and requires the option pool to be 15% post-closing. We want to know what the cap table will look like in this scenario and what the dilution impact will be on each investor. So let's take a minute to pause here and review the terms that we have from each investor. The angel investor had invested $100,000 last year. Since the notes have an interest rate of 10%, $10,000 has accrued, making the total investment $110,000. Also, the notes have a valuation cap of $4 million and a discount rate of 20%. Keep this in mind as we will need this information to calculate the price that the notes will convert at. Next, we have the seed investor who is looking to invest $2 million at a pre-money value of $6 million. He wants to end up with 25% equity stake in the company and requires the option pool to be 15% upon closing. Now that we have laid out the terms of each investor, let's proceed to build out the cap table. To better understand how convertible notes work, we will build out the cap table in two stages. The first stage is right before the seed round, which is when the notes will convert, and after the seed round when the seed investor has put in the $2 million. Let's start with the conversion of the convertible notes. To calculate the number of shares the note investor will receive, we'll need to find out two things: the cap price and the discount price. The conversion price will be the minimum of these two prices. Let's first figure out the cap price. This is the maximum price that the note holder would have to pay when the notes convert into equity. In this case, since the notes carry a cap of $4 million, we will use $4 million as the valuation, even though the company had received a pre-money offer of $6 million. To calculate the cap price, we simply need to divide the valuation cap of $4 million by the fully diluted shares outstanding prior to the seed round. Note that it would be incorrect to use 10 million as the fully diluted share count here. This is because more employee shares have to be issued for the company to end up at 15% option pool as required by the seed investor. To calculate the additional shares that will be issued toward the option pool, we need to multiply 15% by the total shares outstanding after the seed round is shown. Note that this is a circular reference as the total shares outstanding is in turn dependent on the convertible shares. In this case, the total shares outstanding prior to the note conversion will be made up of 9 million founder shares and 2.3 million employee shares, or 11.3 million in total. We can now divide the $4 million valuation cap by the 11.3 million shares outstanding to get 35 cents as the cap price. Let's now move on to calculate the discount price. Remember that the notes have a discount of 20%. This means the note investor will be able to buy shares at a 20% discount to the seed investor. To calculate the price of the seed round, we divide the pre-money valuation by the total shares outstanding immediately prior to the seed round. In this case, the pre-money share price is a little more than 51 cents. By applying the 20% discount, we arrive at a discount price of 41 cents. Remember that the conversion price is the minimum of the cap price and discount price. Since the cap price of 35 cents is lower than the discount price, our conversion price will be the cap price. With the conversion price figured out, we can now calculate the number of shares the note investor will receive upon conversion. Dividing the $110,000 invested by 35 cents gives us 311,517 shares. This is the number of shares the note investor will receive and bring the total shares outstanding prior to the seed round to about 11.6 million. With the first stage of the cap table completed, we can now move on to the second stage to figure out the number of shares that the seed investor will receive with his $2 million investment. This can be obtained by dividing the $2 million by the pre-money share price, which we have previously calculated to be 51 cents. The investor will therefore receive about 3.8 million shares and end up with a 25% ownership in the company. Note here that the option pool also ends up being 15% of the company, which is what the investor wanted. That completes the cap table model. Let's now have a look at how each investor was diluted by the convertible notes and seed round. We can see that the founders were heavily diluted. Prior to the note conversion, they owned 90% of the company. With the note conversion and additional shares for the employee option pool, their ownership was reduced to 77.3% and subsequently 58% after the seed round. For the notes investor, their ownership was diluted by 0.7%. Here we assumed that the notes convert before the seed round, which is typical in most term sheets. If the notes were to convert concurrently with the seed round, the seed investor would be diluted by the note holders and may not receive their target 25% ownership. So let's recap the key takeaways. First, convertible notes convert at the better of the discount or the cap. That effective conversion price determines how many shares the investor receives. Second, expanding the option pool to meet post-money targets usually dilutes founders, not new investors, unless you negotiate otherwise. And finally, modeling all of this clearly, from founding to financing, gives you visibility and leverage. It helps you make better decisions, prevents surprises when raising capital, and keeps everyone aligned. This wraps up our video on convertible notes conversion. If you haven't already, we highly encourage you to read our blog post for more context and download the cap table model, as it will be much easier to follow along. You can find the link in the description below. We hope this webinar was helpful, and if you have any questions or would like us to cover other topics, please email us at hello@alphabridge.co. If your company needs greater support on cap table modeling, feel free to reach out to us through the website. Thanks, and see you in the next one.